Welcome everyone. I'm Susan Murray. I'm one of the partners at Trust Associates, and on behalf of my colleagues and the team at Edison, I'd like to welcome you to the second of our webinars focusing on topical issues affecting investment companies. Delighted to have three speakers joining us today. We have Carolan Dobson. Carolan's an experienced non-executive director and chair. Her executive career was in fund management with, or as head of equities, head of UK equities that is, at Abbey National Investment Managers and head of investment trusts at Murray Johnston. Carolan is currently chair at Brunner, at BlackRock, at Latin American and at Baillie Gifford UK Growth. Our second speaker is going to be James Burns. James will also be known to many of you. He is a partner at Smith & Williamson. He focuses on collective investment products, particularly investment companies, and he co-heads the Managed Portfolio Service and as well as co-leading the multi-asset team. And our third speaker is Anthony Leatham. Anthony is head of investment trusts at Peel Hunt. He joined Peel Hunt in 2015 to help build the investment company business. And prior to that, he was at Investec in the fund research team, where he covered both closed and open-end funds across a wide range of sectors. Now, before we start, just a couple of housekeeping points. Each of our speakers is going to speak for around 5 to 10 minutes, leaving plenty of time at the end for questions. And we're going to aim for a finish time of around 11:45. If you'd like to ask questions, and please do, we have a Q&A tab at the bottom of the screen. So if you'd like to ask your questions through that format, we'll do our best to cover as many as we possibly can. Now, many of you will have joined us for our very first webinar, which focused on the challenges facing investment companies as a result of COVID-19 pandemic. So we listened to your feedback from that, and it was clear that one specific area had particular resonance with you, the dividend challenge. So without further ado, I'm going to hand over to our first speaker, Carolan, who will then focus on the board perspective. Carolan.
Yeah. Good morning. Thank you very much for asking me here to talk this morning about today's income challenges. And to do that easiestly, can you just slip on to the next one, Charlie? I've got a magic man doing my slides, so I don't have to do them. To talk about today's income challenges, I thought it would be helpful for me to go back through how we dealt with our own income challenge at Brunner about 5 years ago, and the procedures we went through would be the same procedures we would go through again should we need to in the future. So I'm really just going to talk through what we did and hope that might be helpful to you. Incredibly fortunately, we completed our plan last year just before COVID struck. And on the other hand, we have absolutely nowhere to hide now. Current markets will tell us whether we had created a good or a bad plan. So just turning over, Charlie, thanks. So when we assessed ourselves in 2015, we found ourselves at a bit of a dead end. Performance was okay, at best, middle of the road, but not very special. The discount was in the mid-teens, and on bad days it got to 20%, despite a fair amount of pretty steady buying in of our shares. The yield was the third highest in the growth sector, but it wasn't high in absolute terms at 2.6%, and in those days you used to get some interest in your bank accounts. And we'd had to dip into reserves in a small way for a few years. Whilst in an absolute key convert, the reserves are there to be used, they're for crises and not really just for life. So as a board and managers, we thought we could just do a lot better than this. So we kicked off two major streams of work. What actually we were trying to deliver for our shareholders now and in the future in the trust, and what would the managers actually like to manage to deliver the best performance they could. So starting off with what were we trying to deliver for shareholders, and what actually did our shareholders want? Well, as you'll all know, it's terribly hard to find out from our retail shareholders what they actually want. But we did have the benefit of a very large family holding, which had been split across many generations. So we had a captive audience who felt they ought to talk to us. So we got an awful lot of information from them across their generations. And the absolute key message that came back to us was that our shareholders wanted reliability. They wanted capital growth, but they didn't want it to be too volatile. They understood that equity markets went up and down, but they didn't want to be 10% below a falling market. And they understood that that meant they wouldn't be 10% above a rising market. So that volatility point has been a key focus for us. They wanted income that they could depend on and pay bills with and not just keep for treats. And they wanted income that would keep up with cost of living increases. The level of yield was desirable. Everybody wants as much income as they have, but it was secondary to the reliability point. And they didn't want to buy companies that did bad things. So the other stream of work we kicked off was we asked our fund managers, what do they want to manage? A kind of free format. What could you do that you could do as well as possible? So there's no point in boards having great ideas of strategies if they don't play to the manager's actual strengths in that. And the key message we got back from our fund managers is they wanted to reduce their income dependence on a small number of large UK companies. They wanted to increase their overseas holdings to get better sector and stock diversification, more pharma, less banks, more tech, less oils. They wanted to reduce the portfolio yield to allow them to buy more quality growth companies. And they wanted to buy good companies because they've always had a big ESG research effort and they wanted to keep their ESG tilt. So we were pretty fortunate that this came out with a fairly clear plan. I wouldn't like to understate the amount of work and think we all woke up one morning and this was the plan. I mean, this was months of work to get there, but the plan did look fairly clear. Sounds quite straightforward. We'll increase overseas exposure. We'll generate income more evenly through the portfolio. We'll increase the aggregate portfolio's balance sheet strength. We'll have companies with better cash flow and earnings growth prospects. We'll have better sector exposure. We'll keep our positive ESG tilt. And we had quarterly dividend payments and we will even out our payments more over the year. And so that sounds really simple, but we can't cut the dividend as we transition because that would be completely unacceptable to our proposition of reliable income. So we did feel this was going to be quite a tall order. So we looked at this and we thought we needed to do this both structurally at the trust structure and also through the underlying investment portfolio. So we kicked off another 2 streams of work. From the structural stuff, we changed the benchmark from 50-50 overseas UK to 70% overseas, 30% UK. Fund managers need to be accountable for their performance, but they have to be against the benchmarks they're being asked to beat. I won't bore you with the story of our debentures, but we had some old historic debentures with very high coupons. And to release the revenue account, we needed to get into modern debt with lower coupons. And I'll just take this moment to thank the Board of Merchants who were our co-partners in these debentures. And at the time, they didn't want to repay them, but they did everything possible to help us. So I'll skip over the years it took us to get rid of them. But once we got rid of them, we could refinance the debt at much lower rates, and we wanted gearing to be used by the manager. We needed to hold back dividend growth for several years so we could move the portfolio to a lower yielding portfolio, which would facilitate stronger companies and more overseas. And we wanted to add revenue to our revenue reserves so we could create that stability over periods of economic disruption. And as I said, we wanted our gearing used by the managers and used actively. From the investment portfolio, we wanted to give the managers as much freedom as they could have to be as good as they could be. So we'd moved to our 70-30 benchmark and we said to them, well, there are conditions sometimes when you want to be one way or t'other. So we gave them a lot of leeway around that benchmark, plus or minus 15, which they could get up to 85% overseas. In terms of the underlying portfolio, we asked them to keep a yield of no less than 90% of the benchmark to give them as much flexibility as possible. But if market conditions needed it for a short space of time, they could move down to 85% yield, to which in fact they had moved in January. And we set 105% gearing as our neutral benchmark, as we wanted the trust to be geared, and we gave the managers discretion to move plus or minus 10% round this. So kind of we inched our way into this strategy at every opportunity. Now our underlying portfolio is about 20% in the UK. Our income concentration is far more broadly split by company and by geography. Our revenue reserves are 28.6p against our dividend of 19.98 last year, so we've 1.4 years cover. Because of that strength, we forecast our November 2020 dividend as a small increase on last year. And our plan is that we'll use revenue reserves to sit out current economic conditions until we see what sort of sustainable level of dividends will be possible from our portfolio. And then we'll decide on a plan. But if we do have to start replanning, we will go through exactly the process we went through in 2015. So any key messages that I think might be useful to anyone is, I think it's really important to recheck your shareholder proposition. What are you saying to people as to what you're trying to achieve? You need to re-examine, can you actually achieve this in current market conditions? If the answer to that is no, what market conditions do you need to be able to achieve that in? You need to agree with your managers what the next few months and then what the next few years' plans are. And then I think you have to clearly tell the world and absolutely stick to it. So I hope this might have been helpful, and thank you for listening.
Many thanks, Carolan. I'm going to pass over to James next.
Morning, everybody. My short presentation is in two parts. First, we'll be looking at just a quick overview of the Smith & Williamson collective investment process, just to give you a bit of context of how we go about looking at fund selection, and then just a few key points that we really want you to consider and we consider when looking at income. So the Smith & Williamson's process, I mean, unlike many of our peers, we don't have a dedicated research team providing fund notes and recommendations for our fund managers. Our whole process is a collaborative one. We've got virtually everyone has a secondary role at some point feeding into that overall process. And in terms of collectors, we've got over 65 investment managers working on both the open-ended and the closed-end side of the equation, looking at the different sectors in roughly teams of 3 or 4. Now, the closed-end funds, the research is generally headed up by me and my colleague Ginevra Bansky von Ambrose, who I'm sure many of you will know, and we get support from our colleagues there, but also working closely with the team on the correspondent open-ended sector. We cover virtually all the trusts there are, with a few of the smaller sectors, such as, say, North America or technology, where they get farmed out and packaged by the open-ended team to cover the sector on a more holistic basis. What it leads to is a universe of about 500 monitored funds, either positively or neutrally rated. All the research notes, performance data feed into this dedicated portal that everyone can just click onto and see everything very quickly. The key thing, though, is that we as analysts aren't looking to make calls in terms of value versus growth or large cap versus small cap. We are providing within each sector a range of options for managers across the floor to pick what is effectively the most relevant and appropriate vehicle for their clients' requirements. So it's a range that I think we're giving to the fund managers out there. Obviously, within the investment companies, access to broker research is a great help to what we're doing in terms of regular messaging, but also the quality of stuff which is out there. And we're very lucky that we, as the size of firm we are, access virtually everything that's out there. And board engagement is becoming more of an important part of our overall process. ESG becoming ever more important. And we're not looking to speak with boards on a regular basis, but it's making sure that the conversation is two-way when we have concerns or want to raise points, but also Geneva and I use very regularly as sounding boards from boards looking to make decisions on such as income and get our feedback on that. So just moving on to what we think are the key points, and I'd stress that these are relevant before, during, and after COVID. I think what's happening in a minute may have accelerated the importance of some of these points, but I think they're relevant all the time. And Carolan has touched on some of these, which is good to see that even though our presentations have been prepared independently, they're consistent. The clarity of messages is probably the most important, to make sure that the trust's aim on capital and or income is very, very clear, as well as the manager's style. We've had Aberforth smaller companies on the recommended list for over 7 years now. Now, it's not been a great time for value within that time. It doesn't matter because the message around Aberforth is very clear and they've got a strong income story. If managers want a value play, that's the obvious one to go to. So it's a very clear message there. And I would, as a board, I'd look very carefully at the analyst coverage you're getting. You're paying a broker, what research are they providing? It's not necessarily the fact they're massively positive. It's just getting that message out there and it's dropping into inboxes as regularly as possible. Obviously, with MiFID II, things have slightly changed, so not everyone gets everyone's research nowadays. And without any conflict here at all, I personally have been a big backer of Edison for a long time, that research which is paid for by the companies, it drops into people's inboxes. It's obviously MiFID compliant. And that message is just there, constantly refreshing everyone's reason why that trust exists and helps with the marginal buying. In terms of the next point, I look at it in terms of reliable levels of income within a total return framework. And when we're looking at making recommendations, it's the sustainability of that income is massively important to us, but aligned with capital growth. You're not stretching one way or the other, it's total return. But to Carolan's point, it's the sustainability is the most important thing for us. Lots of our clients use their portfolios and the income that comes from that to fund their lifestyles. And therefore, we want to make sure as best we can that that is growing ahead of inflation on a regular basis. I think Anthony might touch on this in his presentation, and he calls it the Marmite decision, but payments from capital are not something that we've been particularly, we've been fairly skeptical on it for a number of years. We don't think it's a particularly efficient way to return money to shareholders. Unless you hold it in an ISA or a SIP, you're effectively transferring income into capital into income, and obviously the higher rate of tax that attracts. And also just conscious that there's been several vehicles in the last few years have come out with an income policy attached to asset value, like 4% of NAV, which is fine when the markets are going up, but it's not something that has been shown to be an issue in markets such as what we've currently gone through. And we've just not been particularly keen with it, although I know that some people are perfectly fine. So there's very few vehicles on our recommended list which have big use of capital reserves to make income payments. Again, diversified sources of income is important. It's just making sure that the income the portfolio is generating is not reliant on one particular sector too heavily or geography, and that's just something to stay on top of. But I think it's important to be conservative and prudent. We don't want people to be stretching for all-out income when markets are good, but what we are really keen to see is revenue reserves which have been built up over the years when markets have been pretty positive, and we've been more conscious or cautious around those which haven't been doing that for whatever reason. But we will also say that it's important within this total return framework that you aren't stretching for income, making sure you keep on your AIC dividend heroes record at the expense of total return, which is important. So again, it's sustainable income within a total return framework. And I guess finally, we talk about as an industry how great investment companies are and all the strengths we have. this is a moment we've not had since 2010 when BP cut its dividend, and revenue reserves are one of the key defining features of what we all love, and this is the time to use them. And I think we would have no problem with the reserves over the next 12, 18 months being run down to virtually nothing, because this is what separates investment trusts and open-ended funds. And the longer you can keep this going in a sustainable, sensible basis, it just separates us from the open-ended universe. And in capital reserves, having said that, we don't like to see them being used extensively, I think over the next 18 months, they could be used partially to help maintain this story, and we wouldn't have much of an issue, because again, it's a lever which open-ended funds don't have. So hopefully some interesting points there, and hopefully food for thought and questions later on.
Many thanks, James. That's great. Now, there are some questions coming through, but please do feel free to ask away. We'd like to have lots of questions for our panelists at the end. And I'll pass over to Anthony.
Brilliant. Thanks, Susan. Thanks, James. Good morning, everyone. I was going to start by focusing on the UK equity income sector. We're looking here at an initial slide talking about performance and discount. Apologies if this comes out small, but hopefully I'll cover the main points. UK trust sectors have underperformed the FTSE All-Share year to date. There's no question about that. If we're looking at NAV total return, UK equity income sector average return has been down 21%. Overlay that with discount volatility, shares are down 22% and the index is down 18%. But what those average numbers don't tell you is just the breadth of experiences. So the dispersion has been very high in the sector, with the best performance being down 7% and the worst being down 41%. The discount volatility has actually been less dramatic than the wider sector. And I think that top right-hand chart hopefully shows that. It's been resilient. And I think what this reflects, and probably on an ongoing basis, what this reflects is demand for income is as strong as ever in this current macro environment. The Z-score chart that we like to run, which is the bottom chart in the middle, shows you whether there's any kind of anomalies in terms of cheapness or expensiveness, discounts today versus their 12-month average. And really, the clustering around the middle line there, the middle vertical line, it tells you that not many trusts in the sector are particularly cheap at these levels. If we then turn to the next slide, some headline statistics then on dividend disruption, and as luck would have it, we did publish a note recently talking about this issue. In fact, it was part two of a note as things were moving so quickly. But since the 12th of March, over 400 UK listed companies have cut or suspended their dividends. And although there's a bit of rounding here, we're saying that about 50% of the UK's annual dividend distribution has been disrupted. The worst affected sectors, unsurprisingly, include things like financials, predominantly banks, insurance, travel and leisure, transport, builders. But things are moving at breakneck speed, and I think there could be some upside surprise in terms of dividend distributions in the second half of the year. But this poses a considerable challenge for UK equity income funds as well as trusts. And I think, as James was describing, I think it's the funds, the open-ended funds, that are going to find life particularly difficult as the market has basically gone through a broad rebasing of dividend around what is actually achievable and in the light of significant cash conservation. So what we've done is go through the laborious task of comparing our dividend data on each individual stock with portfolio holdings for the UK equity income sector. And on average, 30% of the UK equity income trusts NAVs were impacted by cuts or postponements of dividends. But there, again, there's a range. So the least impacted NAV only saw 10% affected. The most was 62%. And in the bar chart below, we describe the absolute key, and I really like James's comment there. This is a moment. It's a moment for the investment trust sector to put its hand up and say, if you want reliable dividends through thick and thin, the revenue reserve will help to smooth that dividend over time. We're talking, decades worth of dividend distributions, not just, month to month, year on year. So the chart there shows that of the 22 trusts in the sector that we looked at, only 4 have less than 1 times what we call revenue reserve cover. So this is comparing the revenue reserve today versus the annual dividend payment. The sector average is actually 1.25 times. So I think really healthy picture there for the sector going forward into what has been an extraordinary period. We'll just fly on to the next slide. Here we looked at active management as a sort of broad heading. And I think this will talk to the distribution of income and perhaps concentration risk, which is a challenge, I think, for all equity income investors, particularly in the UK market. If we, in my previous role, were looking at actively managed funds, you'd want to see an unconstrained global equity mandate deliver greater than 80% active share versus their benchmark. So this is the risk they're taking away from the benchmark, but obviously delivering outperformance as a result of deviating from the index. But actually, only 20% of the trusts in the UK equity income sector have come close to achieving this. And I think the chart below that, the commonality review, also emphasises just how much commonality there was, particularly those top 5 holdings. Pre-COVID, we were estimating that 60% of the trusts in the sector had the same top 5 names, give or take, but in different weightings. And that poses a huge issue when you've got big dividend payers in the index cutting or postponing their dividends, and I think that's been felt across the board. So I think dividend concentration, from the conversations we've been having with end investors, that dividend concentration point will be a focal point for investors going forward. And then finally, on this slide, the impact of gearing has been noticeable. At the moment, the average for the sector is 14%. If you take out the top 2 most heavily geared trusts in the sector, that drops to about 11%. And we've seen all sorts of variants across that spectrum. It has had an impact. I think from the point of view of understanding the board's approach to gearing, the manager's approach to gearing, it's almost questioning how much are managers reliant on gearing to achieve that headline yield that they've promised to investors. And then the final slide, really, I thought, given that we've spent time unpacking the UK equity income sector and really understanding perhaps some of the challenges facing the trusts and the managers in that space, I would just step back and review the opportunity set beyond the UK. And actually, over the past few years, the opportunity set has broadened. In the chart at the top there, the bar chart really establishes how many trusts in each region globally have a yield of greater than 3%. And then what we've also done is, across the trusts in each area, we calculated the average. And what this is telling you in broad terms is that there are lots of opportunities to get yield from different sources, to broaden out, to diversify your source of dividend income. Now, obviously, overseas income will bring with it a few challenges, not least currency risk, but I think it does offer the potential for end investors to receive the income they need from their portfolio, but also to diversify that underlying concentration risk. We talked about the Marmite decision. I won't go into too much detail here. We can obviously discuss it in the Q&A, but I'm slightly less binary when it comes to dividend from capital story, I think, for a couple of reasons. One is this flexibility around being able to deliver a consistent yield through thick and thin. Is a very helpful tool, and certainly a differentiator right now versus the open-ended fund universe. And I think certain regions and certain sectors, if you are a pure equity income investor, you risk the income tail wagging the total return dog, for want of a better description. And you find yourself clustered into particular regions or particular sectors. And that can be problematic. In fact, you could be ending up in low growth areas of the market, which do deliver yield, but there's really not sufficient total return there. So we like to allow managers to be as unconstrained as possible. And I think that gets the best outcome from an active strategy. And very finally, from me, on the bottom half of that page, this font is way too small for you to read, but I'll summarize. The Janus Henderson Global Dividend Index report released earlier this year, covering Q1, pointed to quite significant regional divergence and impact on dividends. Really, UK and Europe come out the worst in the near term, not just the disruption we've spoken about, but the involvement of the regulator and the seasonality of dividends. Emerging market classed as very volatile, and understandably so, but actually the US, Asia and Japan, probably Japan being the surprise package there, all come through quite strongly in terms of their regional tendencies, whether it's the spread of income payments quarterly, whether it's the payout ratio driven dividends in Asia that will be less affected this year, maybe more affected next year, and whether it's the cash on balance sheet in Japan and the dividend, the embedded nature of the dividend culture there. But I thought that report actually did summarize quite interestingly the impact for investors. Their best case scenario for global dividends was a 15% reduction. Their worst case in the report suggested a 35% reduction globally, which I thought was interesting. So I hope that's been helpful. I'm sure we're going to have lots of questions, so I'll call it a day there and hand back to you.
That's super, Anthony. Thank you very much for that. So thank you, audience, for asking various questions. I think we'll kick off probably with one for each of the panel, and then we'll maybe broaden it out to multiple answers on some of the questions. So let's start off with one for you, Carolan. So question from Jeremy Richardson here. So apart from the debenture issues, what were the main challenges to execute the 2015 strategy for Brunner?
Patience, really. We couldn't go from where we were to where we wanted overnight because we couldn't have supported the dividend. So we had to just, as I said, inch our way along, look for every opportunity, crawl our way along it. And once you've decided on a strategy, it's awfully nice just to do it. That sort of basically took us 3 years to do it. We were quite fortunate, and we had 2 sterling crises en route. So we'd gone quite a long way before the first sterling crisis, and that then gave us some extra revenue from our overseas portfolio in sterling terms, so we could use that to move a bit more along. But patience and commitment to what you're doing, I think, is the main bit.
Thank you, Carolan. That's great. And maybe a question for James next. Let's go for James. You don't favour a dividend policy based on a percentage of NAV target. What type of policy do you prefer?
I think, like I said, the NAV target is just the fact that it's the volatility which will come with that, which is not what I think our clients who are investing in yield funds are looking for. For them, it's just knowing that they can rely on steady growth over the longer term. And I'm trying to think of an anecdote, but it's probably something like, if you offer, if you've got one child and his pal gets £5 a month or something, and he gets £4, but you know that next year he's going to get £4, and his pal might get £1. He may always probably take the bigger option to start with, but actually it's more sensible to have that steadier approach. And I think that's what we just prefer. As I say, I'm not to say right or wrong, but I just think that if you're going to have a yield target on a trust, it's got to be sustainable.
Okay, thank you. Now, to even it up, question for you, Anthony. So one coming through from Sarah Godfrey. So why do you think UK trusts have underperformed the all-share? Is it just those with value bias who've dragged down the average to the extent that it's below the index?
Yeah, I mean, thank you, Sarah. I do think value bias has had a part to play. Certainly the worst affected have got value credentials that underpin their strategy. Also, all-cap strategies, those ones that are unconstrained, that have gone into the mid caps and the small caps, they felt a lot of pain through particularly the most volatile period, mid-March to end March, and going into April. I think gearing's had its part to play. I mean, much as gearing is a very important lever and tool that trusts can use. it can be very painful in difficult times, and certainly we've seen examples in the sector where gearing was cut and felt that it should be cut, but that also, in hindsight, beautiful thing, hindsight, but that meant that it was cut at just the wrong time. So you're raising cash at the bottom, selling stocks to raise cash to neutralise the gearing, and that doesn't bode well for total return outcomes. To be fair, at this half-year point, the gap isn't that big. You know, it's 3 percentage points between the FTSE All-Share return and the NAV total return of the trust, which is where I spend all my time worrying about. Share prices will do what they do, but NAVs are the reflection of manager skill.
Thank you, Anthony. Let's take one that it would be interesting, I think, probably to have everyone's input on, from John Evans. So he asked, is there a risk that the UK PLC dividend landscape has permanently changed? Companies will increase cover and previous payment levels will become irrelevant for companies and investment trusts also. Who'd like to start off with that? Carolan?
Yes, I think the answer to that is yes. I think the economic landscape has permanently changed. How much it's permanently changed, I've no idea, and none of us are going to know for the next couple of years. So if the underlying economics have changed, then the dividend landscape will have changed too.
Okay, James, anything to add to that one?
I just think it'd be interesting to see the next year where these sort of dividends get rebased to, because there could be companies which were yielding 8% before, which everyone felt were bound to cut at some point, but you hold them until they do. And maybe investors who weren't invested in that for that reason may well look at these companies now that the dividend is 3.5, because that's still pretty attractive. But I guess it's just a case of active management taking advantage of opportunities, and there are, presumably they've had some things in their portfolios yielding very little. Well, you can buy something you avoided before, but actually that dividend you're happy with being solid and able to grow over longer term. It may open up new opportunities. I'm not entirely sure.
Okay, thanks, James. And Anthony, anything to add to that one?
Yeah, I mean, I do think we're going to see a recovery this year. I think there's going to be some that have suspended pending the outcome of stimulus measures, lockdown measures, etc. You can see a bounce back in a lot of the value stocks already as these measures are starting to kick in and people are pricing in some form of recovery. The dividend story, very difficult. I think there's still a need to conserve cash for a number of corporates, and therefore the idea that things will mean revert back to previous levels, I think, is probably unrealistic, certainly in the next 6 to 12 months. If I switch to the trusts, though, I think I do see a tension between a trust's 20-year track record, let's say, of progressive dividend in pence per share terms. That's very attractive. But at some point, that tension might have to be addressed insofar as if the market itself has rebased to a level that's perhaps not letting you achieve that yield commitment, then there will need to be questions asked as to what the right approach should be, whether you should stretch to deliver that, or whether you should apply some sort of a rebasing to the actual trust dividend. But my hope is that you'll see a decent recovery in the market and trusts able to continue their progress with the help of reserves.
Great, thank you. There's some super questions coming through, so to keep sort of powering through them here, one from Tom Harris, which I think again is probably more of a general one. With equity income down by up to 1/3 this year, what role should alternative income trusts play in clients' portfolios? For example, infrastructure, royalties, asset leasing, and so on. Who'd like to kick off with that? Anthony, do you want to go on that one first?
Absolutely. I think alternative income sources were popular before. I think they're even more popular today, not least because they've shown that they can be uncorrelated. So infrastructure and renewables held up particularly well. Song royalties didn't miss a beat, excuse the pun. And that income is very attractive on an absolute basis, but also on a relative basis. So, the demand for those shares, we've seen it in the premiums, is very strong. I wonder whether there'll come a point where you risk overpaying for that income stream. That would be the only kind of worry. Risk adjusted, the yields look very attractive at the moment relative to pretty much every other asset class, and it's an incredible strength to the investment trust universe to have access to those very difficult to access asset classes. But I think there's still an argument for a mixture of income from across the board, but they've proven their worth this year so far.
Absolutely. James, Carolan, do you want to come in with anything on that?
I just say that we've take a fairly global multi-asset approach to everything we do at the firm. It's not just about equities. And I'd echo what Anthony said, that the infrastructure funds in particular have proved their worth. I think the one problem is that when the market does what it did, the underlying fundamentals tend to get thrown out. And even we had some phenomenally resilient performance over the half year from the infrastructure funds. They were still pretty volatile in the worst of the sell-off, and that's just the only frustration, is that this is the correct structure for these asset classes, but invariably it only takes one person to try and sell a bit that no one else wants to buy it, and the prices go all over the shop. But as long as the fundamentals eventually come through, the story plays out. But that's the only thing. And we saw it before in 2008-9. You think you've got something which is a great story, but eventually, if it hasn't gone down and everything else has gone down 40%, people will sell what hasn't gone down. So volatility does kick in eventually, but you hope with the story over the longer term comes through. And I think the story that Anthony says, with lots of these asset classes, which the sector has really boomed in the last 10 years in the back of, have showed their worth, although some question marks invariably have been raised on some as well.
Carolan, anything to add to that one, or shall we move on?
I think generally in creating portfolios, diversification makes sensible. So you'll have some equity growth, equity income, you'll have some more fixed income type approaches. Not all of the alternative income sectors have done well in the crash. Quite a lot of alternative income is dependent on sub-investment grade credit. That looks an uncomfortable place in an economic world under such a stress. Something like the energy funds and infrastructure are much higher credit rating areas with a lot of unique capital going into it under sustainable themes. So just like everything, diversifying a portfolio makes sense as long as you clearly understand what you're buying and why you're buying it.
Excellent, thank you. Let's take a question that focuses it a little bit on the investor. So a question asking, the AIC had been proactive in developing awareness of dividend reliability, income builder, dividend heroes, and so on in the sector. Has that been helpful, or does it raise investor expectations that maybe are just a little bit too hard to meet? Carolan, can I ask you to take that one first, please?
I think it's been really helpful, actually. I mean, the investment structure is an amazing structure for paying income, in that you can squirrel it away in good years and give it bad and out in bad. In OICs, any form of OIC has to distribute income as it gets it. Therefore, it's a far, far more volatile dividend pattern. And it's so poorly understood in the broader population. People who are keen on investment trusts understand this, but my daughter doesn't understand this, or she does now because I've bored her to death about it. So everything the AIC gets that message over with is just terrific. I mean, investment trusts are wonderful drawdown products for people in retirement. So I think it's been great what they've done.
Perfect. James, Anthony, either of you want to come in there, or should we move on?
I think the AIC dividend thing has been really powerful. And you look at that list, particularly at the top, these are long established companies which that you can see that sustainable growth coming through. I guess touching on what Anthony said, that if we did see a real rebasing of dividends across the UK market and trusts had to really make a tough decision, I worry that if you're on the dividend heroes list, it might you'd have that potentially the back of your mind driving the debate more than the actual what you should do. But I think broadly what's on that list probably isn't going to be a problem for some time. Well, Anthony might have a couple he's got his eye on.
No, I totally agree. I think what the AIC have done and highlighting these strengths is really important. There are many conversations I've had where you just bring out a statistic on how long this dividend has been paid and how many years it's been progressive. And there's a sort of astonished look at the other end, and that, as if we can keep that message going, I think that will bring in a lot of investors, new investors, into the sector.
Perfect, thank you. We really are now beginning to be a little bit tighter for time, but let's try and squeeze in one, possibly two, if you bear with us, new questions. So, quick one here. If you had to choose between targets of inflation proofing, reliability, not cutting, and payment from income or revenue reserves, in what order would you give these goals up to bridge the current gap? Carolan?
I couldn't read the question, so I can vaguely remember your order of what it is.
Okay. So shall I tell you again? So
yeah.
The targets of inflation proofing, reliability, not cutting, and payment from income or revenue reserves.
Well, we've structured the whole trust to provide reliable income. So we would keep using revenue reserves to keep the income in a consistent fashion, unless we got to a situation where the sustainable yield level of the portfolio would never support that dividend payment, which is what Anthony talked about, at which point we would start consulting with shareholders as to what to do. My personal view is I don't think we'll get anywhere close to that, but if you did ever do that, then that is an open consultation with shareholders.
Thank you, Carolan. James?
I'm trying to remember the order again.
Sorry, this is really hard, and I've just deleted it. So.
Oh, that's why I couldn't find it. I was looking for it quickly. I couldn't see it. I think the sustainability is the important thing, and I think the reserves are there to be used, and therefore it's a combination of a sensible portfolio where the managers aren't being stretched to deliver the inflation plus return, and then the revenue reserves are there as a fail-safe to help you get through, I'd say.
Okay, our man behind the scenes has just told me where the question is again. So Anthony, if you wanted to go at this, the three options are inflation proofing, reliability, not cutting, and payment from income or revenue reserves. And you need to put your mute thing on.
I think from memory is which one would we cut? Yeah, I think it might be the inflation linkage that would go first. I think the other two are valued so highly by the underlying shareholders and potential future investors that when you disrupt that story too much, it really does put people off for an extended period of time and unfortunately stays in the memory. So I'd say, yeah, the inflation linkage may be the one that has to go first.
Thank you. Now, there are more questions, but in the interest of trying to keep this to our allotted 45 minutes, and it's always good to leave you wanting a little bit more, I'm going to ask each of our speakers just to basically sign off with perhaps a soundbite, a key message from each of your presentations. So we'll do it in order. Carolan first, please.
I think my soundbite really was just be clear about what your strategy is and tell everybody about it.
Thank you. And James?
I think it's, for me, sustainability of income, and this is the time to use revenue reserves. Don't be afraid.
Anthony?
Yeah, for me, having done the analysis, it's all about avoiding concentration risk, understanding what sits below the surface in terms of stock holdings, and perhaps considering going overseas to further diversify your income sources.
Thank you. Well, thank you to all of our speakers, obviously, for very informative and interesting sessions. And many thanks to our audience, obviously, for attending the webinar. We hope you found it interesting and useful, and we look forward to welcoming you to our next one. We're very delighted to hear any feedback from this. So please do let us know what you might be interested in hearing more about for the next webinar. And finally, thank you all again, and enjoy the rest of your day. Bye.